Hello and welcome. My name is Mike Janis, and I'm with Brown Gibbons Lang in the firm's healthcare real estate practice. 2024 has been an interesting year to say the least. As we approach the end of the year, BGL, along with VMG, wanted to sit for a virtual roundtable to provide perspective on the transactional landscape within the provider services space through both the corporate and real estate lenses. I'll be moderating a discussion and will be joined by Kyle, Sean, and Clint from BGL, as well as Andrew, Kevin, and Lucas from VMG. We will begin with a general overview of the market before digging into what's hot and what's not in the context of what the group has seen recently, is currently working on, and is beginning to see more of as we move into 2025.
Fantastic. Thank you very much, Michael. So, as everyone well knows, we've been on quite the roller coaster ride here through 2021, 22, 23, 24. So when we look at where we were, let's just say in 20, we had astronomically low capitalization rates, directly affected by obviously the cheapest cost of capital we will ever see, probably in any of our lifetimes. Going into 22, 21, 22, we saw pretty much steady eddy transaction numbers and volume through both of those years. 23 was the least amount of healthcare real estate that has been traded since 2002. Were transacted in 23. Obviously, everyone's well aware of where the rate market was in 23 in the literal ebbs and flows and radical capital markets that we experienced in 23. That continued on into 24, first 3 quarters. We've now seen finally a break in the storm, and now with SOFR projections in the 5-year going from 4% down through in 2025, we saw really where we thought the third quarter of 24 would be that total break in the rate market. It looks like it's probably going to be January, February now of 25. That being said, we finally have a bearing point. We finally have light at the end of the tunnel, which is fantastic. What we've literally experienced is a deluge of deal flow as a function of that, which is exciting on all ends. Really from a buyer and seller perspective, as there was just a massive divergence in value, perception, and reality, through 23 into 24, but 25 looks to be what we would say most likely a record-breaking year for transaction volume, and very exciting times. Sean?
Yeah, thanks, Clint. I think maybe to add on that a bit, right? I think coming into 2024, kind of really everybody in the commercial real estate industry, brokers, investors, sellers, had a bit of optimism, right? There were 7 to 8 projected rate cuts that were supposed to happen throughout the year. We got to March and inflation numbers didn't come in as expected. And so that rate cut was then delayed and pushed until September. And I think what you saw as a result of that is a lot of investors that were excited to get into the market were looking to get aggressive from an acquisition perspective, really just because they had been quiet for the last 12 to 18 months. Really realized they had to kind of get back onto the sidelines, right? Because now things are back to the uncertainty that we faced in late 2023. When you look at a couple indices, right? So the S&P does a great job pulling together kind of their implied cap rate for any publicly traded REITs. And when you look at the healthcare focused REITs, so really anything and everything healthcare, from medical office to high acuity medical to senior housing, you'd see the implied cap rate in kind of the 8% range, which is 2 to 3 points above where we had seen that previous years. And that really extended all the way through May of 2024. That's when we really started to see that creep down a bit. And that's really just more speculation as it relates to, the public markets, the reaction to that financial reporting. But, we had seen similar dynamics in the private market as well. You had deal volume being relatively flat, right? Activity was flat, consistent with 2023. Mid-year, we started to see, at least from our perspective, the deals that we're working and what we're seeing in the data more broadly, private sector deals are, we're going off, call it in the low to mid 7 cap rate range, which is improvement over, I think, what we had seen in 2023, but reflective of a, continuing high cost of capital. What I think is bringing people back to the table, obviously, desire for investors to invest capital, right? Understanding that every investor out there has a different cost structure, right? Some folks have better access to debt than others. Some folks may have a legacy credit line that's enabling them to borrow at below market rates. And so that drives a lot of disparity in the market. You had sellers who I think are looking to what could, from their perspective, be a sluggish market for them looking to monetize their practice. Who said, okay, there's some money to be made here in the real estate. Perhaps this is a good time to monetize, understanding that the next 1, 2, 3 years might be uncertain from their perspective. So mid 2024, as I mentioned, pricing started to improve, volume started to uptick a bit. With the rate cut in September, the 50 basis point rate cut, seen mixed reviews from the market, right? We'd seen a 50 basis point decline in SOFR, which I think was consistent with what folks expected they would have seen. But the 10-year Treasury actually increased by 50 basis points. And so you have a weird kind of dichotomy here where you think that capital should be getting cheaper, but for many borrowers that are focused and honed in on the 10-year Treasury yield, it's capital still going to be expensive for them. And I think also having an inverted yield curve still to this day is also muddying that picture a bit. As that yield curve de-inverts, I think we would expect that we'd see that 10-year yield come down a bit, but there's historically been a 200 to 300 basis point premium from the federal funds rate to the 10-year curve, and so there's still going to be some cushion in there. And so I think that we're going to see longer term here is 10-year Treasury that is probably in the 3 to 4% range. We might see some relief next year, but probably won't come all at once. I think the good news here for buyers and sellers is that the valuation gap is starting to be bridged, and that's really just based on supply and demand in the market, more so demand on behalf of both sellers and investors.
Well, John, 100%, I think really the divergence I know that we've seen, especially from the physician practice group side, the kind of understanding that, all of the things that we've indicated in the past, really this is a rate driven algorithm, right? So, a lot of physician practice groups that we've dealt with, they said, well, how is that possible that my building has been devalued in the last 2 years, right? And really kind of hitting home on how rate is directly in the spread of these acquisition candidates is directly impacts the purchase price of the property.
One thing I'll add to that a bit as well is just looking at the high cost of debt. The spread between cap rate and cost of current capital is narrower than it has been historically. Typically what we see, and there's no difference in this market now, is more scrutiny and more diligence on the acquisition side, right? So you have acquisition groups that are looking at acquiring single tenant real estate for medical practice, looking at this more almost like they're acquiring a practice. They want to understand, what is provider concentration? Is there any code concentration? Is there reimbursement risk in the practice? What are the four-wall economics of that particular building as opposed to the credit of the entire practice that's signing on to the lease? And so I think that is that's becoming and will remain a key fixture in the transaction market for healthcare real estate, is that enhanced scrutiny and more diligence is here to stay. And I think that's where it's going to be critical over the next, call it 1, 2, 3 years, to make sure that anybody who is looking to go to market and monetize their real estate assets is making sure that they're working with an advisor who's going to come in and pick apart the numbers and really look under the hood to make sure that, you know, what is being presented to the market is being done in the correct light.
100%.
Great. Maybe kick things over to VMG, just from the corporate side of things. Appreciate you had some color on the overview of the market from your perspective.
Yeah, you bet. Appreciate it. And I think that was a great synopsis. I'll just add in as kind of a tie-in. You know, Sean, you had mentioned that kind of enhanced credit analysis and diligence that buyers are looking at, and that I will say from our perspective, as we're looking at real estate investors, we've provided advisory to many real estate investors too, as it relates to as they're looking at potential single tenant facilities and the underlying operators, just to make sure that they understand what they're getting. They're fully aware of all the risks. So I think that enhanced scrutiny absolutely is there. So I think that was very, very, very astute. So we'll kind of give an overview from a corporate provider perspective within healthcare. And again, it's going to be the focus on really the physician provider side for the most part, less in the inpatient and acute, but just kind of to provide an overview here. I think it's really good to bifurcate the market of buyers for healthcare services too, and as well as transaction types. But you've really got the two broad categories of buyers. So you've got your private equity backed MSO platforms. Realistically, they garner the majority of the public interest in the headlines over the last several years, and really rightfully so, because you're talking about the majority of the transaction volume, a lot of high profile, large dollar amount transactions. But then you've also got strategic buyers. So of those, you've got both for-profit, not-for-profit health systems as buyers of provider platforms and provider physician providers. You also have the payers that are involved. You've got other strategic buyers such as pharmaceutical companies, and then general retail buyers like your Amazons, your Walmarts, et cetera, which is really kind of a tangential pharma retail, point of service play there. So you've got those kind of bifurcation of who the buyers are overall, and then you've got the motivation of those two broad categories. And really, from a financial buyer perspective, when you're talking about these private equity-backed platforms, those are your financial buyers. The idea there is building scale through M&A, create value over that defined hold period, predominantly through M&A. We'll talk about in greater detail throughout this discussion here, like that just sole transit, that traditional strategy of building through M&A and then looking towards an eventual exit that is a defined exit that you've got some certainty over is falling out of vogue. And I think, and as you look at it, there's some real headwinds from there going forward. But and then you've got strategic buyers, and the goal there is general diversification, some vertical integration, cost containment, kind of downstream cost containment, referral source capture, things like that. So you've got those broad categories of buyers, and then you've also got the transaction types that we'll talk a little bit about here. You've got your larger platform deals, which depending upon, again, you're looking at a specialty. Typically, these are going to be large. These are going to be in more sophisticated groups. These are going to be large transaction types that you can really then use as a platform then to tuck in additional acquisitions within that specialty or within tangential specialties. Then you've got your tuck-in category, and you've got minority investment as well as joint venture activity. And so again, I think what we'll talk about throughout here is platform deals. Not seeing a lot of trading there, very few over the last couple of years there. Tuck-ins, minority investment, potential joint venture, that's been more consistent, depending upon the specialty, but generally been more consistent than your large platform deals. And I know, Sean and Clint went and talked about it a little bit as well, but just from an overall perspective, M&A trends, 2024 started out even more sluggish than 2023, which was then on the back of 2022, immediately post-COVID, where you saw a lot of activity. And so those have really come down significantly. I think as we entered 2024, everyone was kind of beginning to be resigned to the fact that, you'd bide your time until 2025. There was an expectation of at least initially in 2024 that there could be like rates that were higher for longer, more persistent inflation. As we moved throughout 2024, as both Sean and Clint mentioned there before, then we got some positive readings as it relates to inflation that led to greater anticipation of additional rate cuts, potentially more sizable rate cuts. As we approach the end of the year, we had the September rate cut, which was a sizable rate cut. And then now we bring it back to today, and then there's some uncertainty regarding, truly, are we on a path to consistently lower inflation where we can start to see, more significant rate cuts here moving forward. And so I think that unfortunate places where we thought we probably have more certainty as we approach the end of the year, and maybe now we're in that kind of uncertain position. And so there's a fair amount of caution going into it. I think as far as some other aspects too, you've got the decidedly negative regulatory environment. There's generally an expectation, especially early part to middle part of 2024, that was really a poor environment as it relates to the overall regulatory and antitrust environment to getting these transactions completed, particularly at the state level. We had the 3129 bill in California that was maybe unexpectedly vetoed by the governor there, that provided a little bit of relief. And I think the hope would be that provides a little bit of a telltale sign going forward that we've hit the max of this regulatory constraints, and that maybe they'll be loosening a little bit going forward there. And I guess really from and maybe the last thing I'll touch on here is the loan and lender market. And that was touched on before, but I think we're significantly improved as we look into 2024, and those spreads that we're seeing are coming down. The amount of leverage that lenders are allowing on transactions is increasing from what we saw in 2023. So again, I think we're seeing that all serving as a bit of a tailwind, and hopefully what kind of sets the table for a much more positive 2025, coupled with the fact that because you have this dearth of transaction activity, especially large transaction activity, at some point in time, money's going to get put to play. So the question going forward will be, will it get put to play in sort of traditional, direct PPM space, or will it be kind of on the outskirts that we'll talk about here going forward?
2023 and furthermore into 2024 were unequivocally not the years to do the deal in our realm of provider services in particular. So depending on how you slice the data, healthcare services and then healthcare provider services are down in 2024 in terms of transaction activity, 40 to 60%. So this started, the genesis was around Labor Day in 2022, dislocation in the credit markets. That coupled with more in 2024, you've had increased noise around regulatory pressures, in particular the enforceability of employment agreement non-competes, which fortunately has subsided. Some of the fog is lifted there. So, but that was a concern in 2024. So what this has led to is, is valuations down, private equity in particular extending hold periods. I think it's now a record high above 7 years for hold period on provider assets in the private equity community. Fundraising, the environment for fundraising has gotten more difficult. Fundraising for U.S. private equity up to also a record high, about 18 months to raise funds. So money is not getting put to work, at least in 2023 and 2024. In particular, with larger assets, call it 20 million of EBITDA and above, that are reliant on sponsors as buyers and the credit markets. So the fact that year to date, sit here at the end of October, I believe there's been 4 transactions of provider assets over 20 million of EBITDA to get done. That's staggering. I mean, that should be 40 to 50, really. So look, there's cracks of daylight. There's a lot of conversations going on. There's just an overabundance of supply out there of assets. Folks are getting long in the tooth, looking for liquidity. As I mentioned, where perhaps bigger assets are stuck, smaller assets, you've seen more volume there. And as a function of the market, folks are getting more creative, exploring mergers, a lot of talk and activity in the minority equity play. And then, frankly, it's a good time looking at the entire portfolio for some of these physicians in particular to monetize their real estate. So there's a number of levers, but frankly, in 2023 and 2024, the day of the traditional private equity driven majority recap has not been available as it has in the past.
Let's maybe move over to what's hot and what's not. Start on the corporate side. Kyle, perhaps describe what's hot, most active, perhaps in the context of what you've seen a lot of recently, what you're working on now, or starting to see more of.
Yeah, thanks, Mike. So before diving into specific provider physician practices, tangential to that, a lot of attention's being steered towards ways to play that market, but perhaps one step removed from employing physicians. So there's a lot of activity, a lot of conversations going on, assets coming to market in staffing, RCM, infusion, and ASC management. In general, a lot of the conversations recently we've been having with the private equity community, seeing folks that are risk on for provider, where at the beginning of this year in 2024, a lot of folks were out of the game for new provider businesses and driven because a lot of them have assets in the legacy portfolio and perhaps are over indexed, but perhaps it's a little bit of selection bias and seeking those conversations for folks that are still bullish on the sector more broadly, but some promising signs. So more broadly, outsource clinical services driven by the contract nature and less reliance on M&A, and then primary care in various stripes, sizes, flavors, if you will. Within, call it the single specialty, more ancillary levers. This is all going to the premium ascribed to organic growth. Pain management comes to mind. A lot of activity going there. It's just very ancillary rich. And then naturally, just broad trends. I mean, folks, the spotlight has been shown on provider retention. So across the board, regardless of the subspecialty, geographic density, these are, old trends, but now back at the forefront. So folks, I think are less likely looking for the next novel subspecialty and more just say, hey, let's hunker down, let's focus on the business. Especially in a market where I mentioned folks are perhaps over indexed, some of the usual suspects and provider services investors. So when you have perhaps generalist funds, some more consumer driven funds coming into the sector, they're just back to the blocking and tackling of, is this fundamentally a good business, a good platform to invest in?
VMG, anything to add on the corporate side?
The only thing I would kind of tack on to what Kyle mentioned there, as far as and just mention a couple things. The look at internal. So you got what your existing platforms who would have liked to trade perhaps, but have not had the opportunity to, and are now looking and saying, we're not going to do it this year. It's going to be 2025 or beyond. Let's focus internally and focus our own kind of internal house. What are they looking at? A lot of this, because they know the next buyer, this is going to be critically important because this is one of the pain points for existing platforms. But it's really putting, what does provider compensation look like internally? And is that provider compensation at a level? Do they have an internal process in place to allow for adequate physician compensation that's truly scalable and that's durable moving forward, and that you can recruit into and you can have succession planning into, that's not entirely relying upon the next bite at the apple and entirely relying upon the value creation of any type of rollover equity and an eventual exit. Because I think they know that that's going to be, critical for them to prove to whomever their ultimate next buyer might be for that platform, is to have a provider comp model that's not just a revolving door of who will accept the level of compensation that perhaps the original physicians who are part of the deal accepted because of the fact that they received proceeds and rollover equity, that there was an expectation of value creation there going forward. So I think that's a big focus overall. And then we've seen, I mentioned it previously, but a lot of activity with just general tuck-ins too. So, continuing to build the platform, especially in areas in which they already have some level of geographic focus, under the hope that that's a more efficient platform. If you have greater geographic focus, you also potentially can create some additional leverage as it relates to rate discussions with payers. And so as well as just, general management density within that particular population, geographic population. So I think those are broad-based before we step into any of the specialty focus.
Yeah, so on the specialty focus, I would agree with Kevin and Kyle completely in what they've mentioned here so far. I'd make a quick observation on that. When we think about those investor groups that are stepping further out on the acuity curve and all the movement/interest we saw in the cardiology sector in 2023, the orthopods a little before that, and in 2023, one of the areas of interest that has also slowed down, but may be inflecting here, is behavioral health. We've seen a few things in that area from a sell side perspective that are in market currently, and once they trade, it is the hope and perhaps even expectation that the ice will break and investment volumes will pick up again in 2025 following those major asset moves. And this is particularly true when we think about subsectors within behavioral health, such as ABA therapy, IDD services, and mental health to a certain extent as well. Whereas some of those other pockets within behavioral health naturally lend themselves more towards de novo strategies and less so towards M&A, but overall, we certainly see that as an area where there is real investor interest in, again, behavioral health and those subsectors specifically. I should also say both buyers and sellers are paying particularly close attention to the trends, both in valuation multiples and overall transaction types. Who are the partners who are coming in and making bids? What is it that's actually moving and gathering real interest and momentum here as we head into the end of the year? And what we see from our perspective that's really catching the eye of potential investors, and to a point made earlier, are businesses where there can be real organic growth and not necessarily rolling out the M&A playbook and then having to pull together 1% to 2% of incremental EBITDA through cost containment or other margin improvement initiatives, only to have to add another and another and another to generate that overall growth in the total platform. Instead, though, where we see the interest is really following along with early stage trends in the marketplace in terms of care that is being sought and provided and needed, and going out into the market and filling that care gap with these in-need specialties. So you think about the mental health state of the United States and really starting to fill that gap over time. So that's certainly an area that we've seen a lot of interest, and we're keeping an eye on it and having continuous discussions from both a buy side and a sell side perspective, just keeping our finger on the pulse there. And one area that has certainly not slowed down, in contrast to cardiology, orthopedics, and then behavioral health to a certain extent in the last year and a half, but only really picked up, Andrew, is where you spend a lot of your time with your team, and that's aesthetics. Do you have anything you'd like to share here in that market?
Yeah, I do. The aesthetic space, and you can really lump, a few different specialties within there, but plastic surgery, there's certainly, is getting hotter, if we're talking about hot or not still. But certainly, probably for the last 3 years, we're seeing a lot of interest in the medical spa space. And medical spas are interesting businesses. Primarily, not MD driven, although there are medical directors, but the provider base is typically mid-level providers, injectors, estheticians. We're about 3 years in the medical spa space in terms of consolidation, but the medical spa space is highly fragmented. And it's, again, an interesting business model, all cash pay, reliance on mid-level providers. There's a lot of interest. There's new buyers seemingly entering this space, kind of on a regular basis. I mean, there are some established platforms out there who've taken different strategies. Some have taken a strategy of we're going to build mass immediately, take on 20, 30, new tuck-ins over the course of a year, where others are taking a slower approach and building density slowly, and maybe more selective with what they're who they're transacting with, either based on geography or whether it's primarily urban markets or maybe secondary markets as well. So there's a lot of capital in this space. There's a lot of capital and it's not all been deployed yet. And in my mind, I think there's more platforms to come in this space. So yeah, it's very hot right now. Yeah, it's a good question. Is ophthalmology or eye care in general, is it hot or is it not? I'm optimistic that it's still hot. It's just stagnant. Interest has not gone away by any means, but it's just based on the factors we've discussed about with interest rates and just in my mind where we sit in the life cycle of consolidation within ophthalmology. We're about, I would say, 7-ish years in terms of consolidation within ophthalmology. So you're at that spot where we likely should have seen more recapitalization activity by now. Of course, we got stuck in the middle of a pandemic and then a tough economic environment. So it certainly slowed things down. From conversations that I have with the platforms that I work with, they're all looking at recap activities. A number of them are still with their original sponsors. But, there is optimism for 2025 in terms of the recap space. But we were also semi-optimistic a year ago, and that's turned out to be a bad prediction. There are a lot of deals taking place, but just at a slower volume right now within the eye care space. There's been some announcements this week about new deals coming to play, but from a seller perspective, there's certainly interest in doing transactions still, maybe just at reset valuation expectations. I think in my mind, I hear a lot about, well, this is what I could have received in 2021, but well, it's a different market now, so I think seller expectations have been reset. And for the platforms I work with, everybody's open for business in terms of doing M&A, but just at a much slower pace, and other factors we've talked about just heightened scrutiny around diligence, both on the financial side, Lucas, which you focus on a lot, but also on the regulatory and compliance side.
Andrew, question for you. When you look at the sequential nature of, we always advise practice to monetize their property company before their operating company, obviously has a full aspect of control. As you look at the market, right? So it seems like, as Kyle has indicated, this is not the year to do the operating company deal. We would say we're kind of going into 25. It's probably a very good time to take a look at the property company deal. Just out of curiosity, the sequential nature of this. So say it takes 6 months for us to orchestrate a property company transaction. when do you foresee the kind of the operating company trade of a hypothetical practice?
In terms of the timeline of a transaction taking place?
Well, really market. So, we would say this is very much the market to trade the property company in. Do you think, end of 25 is it an opportune time to monetize the operating company from an eye perspective?
Yeah, I do. I think conditions will continue to improve slowly. But I think we'll start to see a lot of that, next year. But that's more on the platform level. But I think that'll start to happen more.
Yeah, one note I might just say, because we mentioned valuation a couple times, I do think it is kind of an interesting component here where there was always an expectation of when will these get repriced in light of current dynamics, current macro dynamics, current demand for these practices, whether it's smaller tuck-ins or platforms. And I think really the dearth of platform deals, if we were 2 years ago, we were right on the tail end of a lot of platform deals in many of the specialties that were at really, really high multiples of EBITDA. And so then if you're a tuck-in, if you're a smaller practice, you recognize that you maybe need to be at a small discount to that, but not too much of a discount. And so then you're kind of attaching yourself, ascribing yourself to these really large platform valuation multiples. And now that there has been a significant dearth of these platform deals, we're now a long ways away from that. So I think it is aiding as far as a resetting for especially tuck-in transactions to where you have sellers that are willing to accept more moderated prices and ones in which the buyers can get behind too, and still have some synergies, some accretive nature of what they believe they can trade for as a platform.
Well, and Andrew and Kevin, so you're talking to multiple, so kind of where we're seeing the eye trade right now is within that kind of 15 and a half times multiple that was right in the sweet spot, let's call it 2021, 2022. So I would say that we're kind of right in the we're back to the good old days, so to speak. Obviously, you've seen a discount in multiple. I guess do you see that continuing the path, or I guess what's your perspective there?
I think continuing the path, not necessarily downward much. I think we likely have hit some sort of floor on the multiple declines, but I don't necessarily see them picking back up again. So I think we're probably flat there. I don't know, Kevin, any thoughts on that?
Yeah, no, other than for small tuck-ins, most commonly we've seen on the opco side, I mean, we've seen multiples certainly below a double-digit multiple. Occasionally you creep in to the low double digits, but those are usually competitive situations. We've heard, and we work with a lot of health systems who are perhaps competing, especially for certain high acuity specialties, competing for practice at potential acquisitions or various affiliations as hospitals look to kind of position themselves in the best place to how do we compete with perhaps a similar structure, or do we just continue our sort of direct employment strategy, acquire the practice and do a direct employment strategy with a medical group.
And so where we've seen, on the RE side, that multiple, just looking at opco to propco, placing, the larger amount of EBITDA in the lease rate where you can really achieve, right, a 15x versus, I think as you're indicating, kind of in that, high or low double digit, maybe high single digit. It's a very advantageous time, as Kyle indicated previously, to really delve into that deal as a practice seeks capital, because it's just simple math, right? If we're able to exponentially change each dollar of EBITDA and change that to rent, a lot of these practices are really seeing a advantageous way to achieve large sums of capital.
I think another trend that I'm seeing, and this is ophthalmology specific in terms of my example, but I think it's probably true for other medical specialties, is just the impact on physician compensation in terms of as a driver of continued pressure on EBITDA margins. If you just think of from starting with a big picture of a pretty significant supply demand issue going in terms of providers leaving the specialties that they're working in, either hitting retirement age versus the number of new providers entering the specialty, either out of training or just interest level overall. And that's forcing physician compensation rates kind of through the roof right now. And whether you're a privately held practice or a private equity backed practice, the physician recruitment market is really, really tough right now. And where that has an impact, in my mind, as we're talking about today, is a lot of times if I'm a physician, I sell my practice, I'm trading essentially EBITDA for reduced compensation going forward in terms of what it looks as the seller. And if I'm making now 35% of my revenue going forward, yet and then I'm going to retire in a few years, the people that I'm having to recruit to replace me are coming in at much higher compensation rates and likely not as productive from a revenue standpoint. So it's creating even more pressure, I think, on EBITDA margins, and it's obviously therefore is impacting not only for if I'm a practice selling, but also if I'm one of the platforms, that my margins are much tighter. And that's I think that's another driver in terms of the recapitalization timeline.
What are you seeing, MD versus OD? I mean, with the uptick in the practice, in the actual procedural base that OD is able to achieve. I mean, is that a way to? I guess, what's your perception on the OD compensation package versus the MD compensation package, and is that a advantageous way to increase EBITDA by having potentially a lesser cost from a employment perspective?
It can be, and it can be just similar to dermatology, where MDs and PAs. It's all dependent on scope of practice, what I can do, or what a mid-level or an OD or a PA can do versus what an MD can do. But the way I look at it is, for some of the maybe non-surgical type patient care that can be performed, how much of that can be shifted to a mid-level or an OD, which then frees up the MD to be more productive, to focus on higher kind of revenue rate per procedure, help with surgical volume, all of those things. So that's I do think where you can see some kind of margin improvement there.
Kick things over to Clint and Sean. Same topic, kind of what's hot on the real estate side. What are you seeing out there, seeing more of? What are you working on these days?
Great. Yeah. So look, I think from a real estate perspective, obviously we've seen an uptick here in activity, kind of Q3 into Q4 of 2024, just relative to the last couple of years. Spending a lot of time kind of in the MSK space generally, so ortho, spine, and pain. I think we're seeing a lot of activity within all three of those specialties. I think it's generally bifurcated really by practice size and how those transactions look, what the motivations are. As reps starting with looking at the ortho spine space, especially when you're looking at larger groups. I think what we're seeing there generally is a couple dynamics at play. And I think one, you have a number of physicians that are perhaps a bit more advanced in their career, folks that are looking to take some money off the table, get some return on the capital they've invested over a number of years, and also be able to, possibly reshuffle some of that equity to some of the more junior partners. Separately, the same practices that are frankly looking to reinvest, and that could be either within their existing facilities or building new facilities. And so I think an attractive way for these practices to do that is through a sale leaseback transaction on the real estate side. Consummating an off-balance sheet financing transaction like this basically provides a relatively cheap source of capital, and typically is well received, especially when you're looking at markets where historically the rents, when you have an independent practice and their own real estate where they're controlling that rent, oftentimes we're below market. And so even with coming up to market, that long-term lease liability isn't something that's so daunting to the more junior partners that it's going to be an obstacle later, kind of within that initial lease term. That can drive a lot of value in the market, especially when you're looking at large groups where there's not much in terms of provider concentration. Those that are mature, that have high ancillary rich specialties like ortho and spine. When they have a productive ASC, perhaps still some capacity within their ORs for added growth in the coming years, but at least that has a stable track record of performance. Those are driving cap rates that are at the top of the market. We've seen large properties or portfolios trade kind of in the 6.5 cap range, which really is above market for really most anything aside from any properties that have a corporate credit attached to them, be that a not-for-profit health system or one of the large corporate operators. When you look on the smaller side, so practices with a handful of docs, oftentimes this is something that's done either coincident with an M&A transaction. I think it's been noted that perhaps we haven't seen a lot of large M&A deals happen in the last 12 months, let's say, but an opportunity for these physicians to monetize, is through tuck-ins. If you're a smaller practice, you can sell the practice, get a bit of credit enhancement, and then that, provides, more value to the real estate component of the practice. Separately, if, you have a practice that's frankly waiting it out, waiting for the market to turn, perhaps they aren't in a geography where serving as a tuck-in for one of the private equity backed platforms, it just really isn't strategic for them. And so they may need to sit on the sidelines for a bit longer, but in an effort to get some return of capital for their investment, in the practice, and that's in the practice and the real estate, the facility itself, they're able to realize a return from that perspective as well. I think, from a specialty perspective at a high level, real estate investors really like ortho and spine. I think what you're seeing here is a significant uptick over the last couple of years. I think a lot of that's due to improvements in the quality of the joint implants that are going in. But for example, knee procedures are up significantly for adults between 35 and 45 years old. And then obviously you have just the ongoing trend of the aging baby boomer in the United States. And so, if you're in an area with any geographic density and you have a, fair amount, at least, call it national average or better of a 65 plus population that's continuing to grow, that's going to be viewed as a good credit risk, or at least a good attribute when an investor is analyzing that credit risk. Separately, we kind of look at the interventional pain space, which, we kind of group in all into one with MSK as we think about things. Interventional pain, I think, is very in vogue right now. The M&A markets are fairly active in that space. We are seeing the same. We're seeing the same on the real estate side of the house. I think a lot of what we're seeing are deals, frankly, that are real estate deals that are attached to an M&A deal. So they're happening kind of coincident with that M&A transaction. And then we're also seeing some, frankly, some smaller interventional pain groups that are looking to monetize their real estate, but that's more kind of under the guise of an off-balance sheet financing transaction to fund capital improvements to their practice, be that clearing other debt that's on balance sheet for the practice, improvements to an ASC, et cetera. So I think generally we're seeing a lot of activity in the space, and I think that will continue and grow into 2025. Clint, perhaps kick it back to you if you'd want to run through some of the other specialties we discussed.
Certainly, and extremely well stated, Sean. So, as we look at, each of these specializations, again, as we look at each practice, really everyone is headed in the same trajectory from a large practice group perspective, in that the divergence of new partners and the old guard of property company owners. So in 2021 for urology, there were 333 newly minted urology residents. It's an extremely competitive market to obtain that that finite supply of providers. Because of that, we've seen very competitive propositions on the operating company shareholder side, and all of the practices that we talk to are all different but similar, right? So, as we look at 2025, we would see this as a very advantageous time period to really hone in and let's figure out that solution for both the individuals that are in the operating company side, but not necessarily in the property company side, and really understand that. And really, worst case scenario, right, is a operating company transaction happening before that property company transaction. Obviously, you've lost control of your the decision-making capability of the operating company, which is ultimately the value. So in urology, we're guiding, a number of these groups because they're very large, very, very high scale in a market and market percentage. So by and large, you're looking at in the smaller markets, you may have, really one urology provider that takes up 80 to 90% of market share. So, that's very important for, kind of all of the holders of PropCo to really take a deep dive and a deep look here at, how we make that make sense for kind of all parties involved. Obviously, best case scenario is, you're one-to-one on your PropCo and OpCo, and it's, easy. But, that's really not necessarily the way these practices take shape in order to be competitive and be able to acquire, just a extreme dearth of talent. There's only 333, right, that you can obtain. And so because of that, each of these newly minted surgeons and urologists are really not looking for property company ownership. They're looking for operating company ownership. And, obviously with every share comes a divergence in your majority or supermajority decision-making capabilities from a lease perspective. So I guess what we would say from the urology front, it's probably the most pressing issue because urology practices are just larger in scale than necessarily your mid-sized orthopedic group, your ophthalmological group, your derm group. So that is kind of the most important aspect that we would really stress for the urological front. Getting into derm. So derm, we've done a number of transactions this year, and we'll continue to do a number of transactions going into 2025. So we have been able to press lease rates here, into the upper boundaries of kind of pseudo ambulatory surgical center and high acuity clinic. So when we're getting into Mohs facilities, obviously they're not as acute as an orthopedic surgical setting, but they still have very strong EBITDA, very strong rent coverage ratios, and because of that, we've been able to push those dollars into lease rates that, as we indicated before, are generating immediate 15x, let's call it a 2 exponent of, kind of where that opco trade is. So that's our advisement. Obviously, BGL, we are both advocate for the practice as well as the property company, and the holistic approach that we have in understanding both those aspects is paramount to the success of, all parties. So understanding the two transaction nature of these things is extraordinarily important. Furthermore, on the I front, we've seen a lot of movement from the acquisitions of the PE backed in the from a corporate perspective. So quite frankly, we've been able to do some pretty extraordinary things with a couple of our clients in value perspective. So essentially taking a historical EBITDA basis and a historical generation of really truly successful practice in doing nothing more than changing the operating company. We have seen monumental outcomes for our sellers from a function of the trade of the real estate. So a building that would be worth X, we've been able to quadruple that value simply as a function of orchestrating the tenant that's standing behind the lease, and really with no track record in the facility, so no unit level financials, which is really pretty special. Sean, I know you've been extraordinarily active in the senior housing, assisted living, IL, and memory care fronts. Maybe you could speak to that.
Sure. No, thanks, Clint. Yeah, and look, I think senior housing is, an interesting market in that it is, largely driven by the real estate. However, more and more, I think, especially as you kind of go, call it up the acuity chain from assisted living to memory care to skilled nursing, right? There's more and more of a value add component that's needed there. I think obviously we'd seen years ago, right? You had a lot of REITs or private equity funds, find a kind of dedicated partner, to run the actual operations, to serve kind of as a fee-for-service manager for each one of the properties within their portfolio. I think we've seen, recently is a lot more alignment on that front between the real estate investor and the management company. We have seen private equity that is traditionally focused on the opco side. So, that would invest in, physician practice platforms, for example, now investing in senior living platforms that really are serving a number of functions. And that would be acting as kind of a property manager, but also providing ancillary services for everything from home health, primary care, hospice services. And really it's all the value add services that go into a senior living facility, and namely a CCRCs, where you kind of are serving a broader swath of the population just based on their general acuity. There's a lot of interesting trends when you look at this market. I think first off, obviously you have an aging population. The 80+ population in the U.S. Is projected to be 20 million by the year 2030. That was only 13 million in 2020, right? So that's pretty significant growth over a decade. Within that cohort, or even a broader cohort, 80% of individuals 65+ right now have at least one chronic condition. And so what that would suggest is that, over the mid to long term, you're going to see a lot of folks that are going to need help and assistance in their day-to-day lives. And living at home may not be an option, particularly if they don't have access to home health services or have family members that are going to act as caretakers. I think aside from that, there's a lot of activity that we see that is going to come down the pike here in the next couple of years. Most of that being driven by the real estate component here. There's a lot of debt that's going to mature, that has matured in 2024, and that's going to continue to mature in 25 into 26. And an interesting statistic is, on average annually, from 2013 to 2022, there were about $3.8 billion of loans that were coming due annually that were tied to a senior housing facility. Now, that number is $8.2 billion in 2024 and is going to be $10.1 billion in 2025. So there's so I think what we've seen is a lot of investment in this space in the mid-teens. Perhaps portfolios weren't, the maturities weren't staggered as much as maybe they should have been. And now you're seeing a lot of distressed assets go to market. But that's creating a lot of opportunity for folks looking to acquire and either expand their current platforms or stand up new platforms in the senior space. Really, in addition to that, new starts are down in a big way. So new construction starts in the senior housing space on a trailing 12 basis are at the lowest point they've been really since 2010. It's down 80% since 2018. A big part of that is being driven by the lending community, right? You have lenders that are looking to de-risk their books from any new construction risk tied to the senior housing space until they're able to work through all these maturities that are coming down the pike. So not only do we have demographics that are driving towards increased occupancy, increased need for this product within the space, but you're also seeing now operators that are unable to stay in their deals, frankly, because the capital calls are too rich for their blood. And you're also, seeing a lack of new construction starts. Even if those construction starts were happening now, they won't be at the point of occupancy for at least 5 years, just with permitting, financing, construction, all the things that go into, finalizing those buildings to be move-in ready. I think pricing in this market is still kind of materializing. Cap rates are still 100 to 150 basis points higher than what we had seen kind of in the pre-interest rate hike level. So call that 2021 into early 2022. A lot of that's due to aging facilities. And, what we're seeing and hearing from investors here is that there's not as much interest in older vintage. So properties older than, let's say, 2010 are starting to raise red flags. That could be due to efficiency of the building itself, could be due to operational efficiencies. Does that create any issues with any of the value-added services that they're investing in to basically build around their just basic management of an assisted living property? And also, there's changing consumer sentiment, right? Tastes are changing. You look at the baby boomer population now, that's the largest concentration of wealth in the United States. And so folks are looking for something that's a bit more, call it of a luxury accommodation. And even if that's not luxury, as a lot of folks would think about that, still luxury relative to what you would see if you walked into, a senior living facility that was built in the 1970s or 1980s, which, call it in the 10 years ago, were still very much in play. And they're still in play today, but they're not going to achieve the same premium from a valuation perspective as likely newer builds will. But it's going to be very interesting times in this market to see really how everything reshuffles, particularly when you look at a lot of investors that, made large splashy investments in senior living portfolios that have now lost 30 to 40% of their value, that will be looking to basically sell those off to the highest bidder. Who those buyers will be and who their strategic operating partners will be has yet to be seen. But that market's taking shape, and we're very excited to see that happen.
I perhaps move on to the back end here of the what's hot, what's not. So maybe move into what is not. Perhaps start on the corporate side. Perhaps VMG, Kevin, Andrew, Lucas. And what are you seeing as far as what's not hot on the corporate side there?
Yeah, you bet. And maybe what I'll focus a little bit on is just general, without getting into certain specialties or specifics, but just we talked about it a little bit, but your larger PPM exits, I think those are certainly challenged there. I think what we're seeing now, unless your top qualities, sponsors are holding, they're working on integration, operational improvement, tuck-in M&As, things like that. I think that the reality is they will trade. It's just a matter of at what price. And I think the challenge they face is what's the value proposition for the next buyer, and this is kind of part of the whole roll-up strategy. But what's the value proposition for the next buyer? Is there still a runway to consolidate for that specific vertical or subspecialty? If yes, if there is some, then what about the next buyer, of course? So important to look at total addressable market within that specialty. Also, have they shown an ability to recruit into that platform with the existing provider comp model? Andrew mentioned it earlier within the ophthalmology space, but just the lack physicians are hot commodities. So like supply demand, there's an imbalance there as far as demand outpacing supply. So that requires high compensation levels, which are then some of these MSO models are not necessarily set up to allow room for that. So I think you as we look over the next couple of years, those that aren't positioned well there, there's going to be some challenges. Perhaps they'll have to go through a broader restructuring. Perhaps they'll have to sell it at lower levels than what they had, what would be their preference, or even what they got in at. So I think that'll be interesting to see going forward. Can they introduce value-based models? Really, that's more difficult when you're talking about subspecialists. See it much more from a primary care perspective. So again, I think from a what's not perspective, that's probably what we're seeing. Maybe a little bit on the specialty side. Hospital-based medicine groups. Those groups are certainly challenged. We are seeing some of those groups when we're talking about hospital-based medicine, like emergency anesthesia, where's hospitalist groups, some radiologists kind of fall in that category too. But you were seeing some activity where those groups that are previously with a corporate partner, perhaps looking at now becoming employed and joining up with a hospital group because of perhaps challenge strategy with their current model going forward. So maybe just touch on one there. But Lucas or Andrew?
Yeah, I'll jump in. I think one thing that is not hot, again, just from a general perspective, is the use of kind of pro forma growth assumptions in terms of valuations. And maybe in the past, being able to get credit for that, if I'm the seller, being able to get credit for some sort of future growth assumption, where just the risk environment right now, we're seeing, significant pushback from buyers on being able to use those types of assumptions, and or maybe more specifically, not being able to get cash at close for that type of assumption. So maybe you do get credit, but it's more in the form of a future earnouts. That's the one thing that I would add in terms of something that's maybe was a little bit hotter, but it certainly is not right now.
Yeah, and I would follow on with that just to say that when we think about structure for sellers as well, when we think about what percentage of that purchase price is actually going to be allocated to equity in the new co or in the parent company, we're starting to see sellers push back on that number because, as we've talked about kind of throughout and from various viewpoints, the lack of secondary trade and the longer hold periods makes these founders think, I spent my life building this practice and I'm exchanging 20, 30, 40% of it into equity in this new company. If it's going to take another 8 years or I have some put option to actually monetize that's a real consideration that these sellers are having to think through now, because that second bite of the apple that was kind of dangled out in front of folks is as we grow, you grow, and you'll benefit as well. They're waiting to see that come to fruition. And more we're seeing that become a stronger point of negotiation as we head towards close.
So all very interesting insights as usual from the VMG crew. One item before we get into what's not, that Andrew addressed on pro forma and credit and perhaps how that leads to structure in a deal via contingent payment. I would say the the appetite there and the use of structure is really burning off. This is an element that in ripping bull markets, it's all cash and equity, getting paid for growth. Really starting with COVID, you saw the reintroduction because you couldn't really look at what was a normalized period. And so that's continued to the benefit of perhaps buyers in terms of a balance of risk going forward on projections. So we are just seeing that wear off a little bit, and it's expected to wear off, as that was a little bit of leftover from COVID. But dovetailing on what Kevin mentioned, sticking to broader themes, if we want to talk about what's not in vogue, rather than pick on one specialty, I think because it's an interesting question that you can say, what's not in terms of value degradation or what's not in terms of volume of M&A activity. And I think broadly speaking, because there's a lack of transactions, it has created the snowball effect. You could point to various sectors, orthopedics, ophthalmology, dental, you name it, where sellers that are holding, there's a lack of real-time market comps. So it seems to be a high stakes game of chicken that the first trade in any given subsector will be the one that breaks the ice. And then we know that there's pent up supply of transactions to trade within every subspecialty. So if you look at it back in 2022, folks were looking at it and perhaps saw a 10, 15, even 20% reduction in multiples. They went out to market, then hit what I alluded to before on kind of the credit market fracture towards the end of 2022. So folks are wondering, the big question is that come down, or have we perhaps bottomed out and is going back up, as Andrew alluded to in ophthalmology. And so I tend to believe in what we're seeing and hearing is multiples are slightly on the rise. But it's interesting because, our folks, it seems the sector that's willing to accept what the new norm is in valuation, and therefore be the first one to transact, is going to open the floodgates. And so you'll see more activity there. I point to things that are enabling, reduced value is just largely unintegrated assets, and folks that are M&A dependent. And so largely, and why I'm saying sticking in more of at a higher level, because within a category, take retail medicine, has largely been highly a voluminous M&A specialty. I think that's more out of favor. But then if you go deeper in there, if there's a asset with perhaps a direct to consumer de novo growth strategy, that's going to be trading at a premium, regardless of a down market. So I look more towards elements of a company versus any given subsector.
On behalf of BGL and VMG, I want to thank you for tuning in to hear these insights. It will certainly be an interesting next few months, and we look forward to evaluating what lies ahead. We hope you enjoyed listening in. If you want to reach out, visit bglco.com or vmghealth.com.